All right, good afternoon, folks. Recording this video hour and a half before the closing, so don't really care about what's happening right now in the intraday. It looks like a doji day, flat day, SPX, QQQ, etc. It's fine. All right, and that's what we kind of suspected that, with the ex-dividend announcement today, OPEC's going to be very choppy type of action. It's cool. All right, so I'm going to move pretty quickly here. So headlines for the week: new all-time highs at 572 for the index for SPY and SPX 5700s. So that's wonderful. Our downside call this week was 542 after the announcement of the Fed rate cut. We did give our viewers a scenario where we would actually go past 5,700, and that would be a dovish rate cut, and that's what we got this week. So FOMC cut the rates by 50 basis points. In addition to that, they signaled a 25 basis point rate cut for the next two meetings in November and December, effectively one full point rate cut by end of the year. So that's all very good. So now what do? Right, we're all at all-time highs. So be aware, next week is GDP and PCE data. You can have a ton of Fed speakers coming back online, so just watch out for that. So PCE Friday and Michigan, Thursday is going to be GDP and jobless claims. That'll be important. There will be bonds buying operation in Japan on Wednesday evening as well, so you want to keep that in mind. I want to go ahead and jump into the seasonality chart here, and we've had a significant run up over 300 SPX points since September 11th lows, which was at 540. We ran all the way to 57, almost 5720 just yesterday. And so this is actually just looking exactly like seasonality goes. So we're probably somewhere around here, late September meltdown, and we will be able to buy more dips or be better positioned to buy dips versus buying at all-time highs when October rolls around. So as you know, the monthly candle closes next week, and also the month closes out next week. And we're typically headed into a pretty tough period all the way up to mid-October. So that's the assumption that we're rolling with right now. So real quick, my upside target next week is going to be 573 if we even get there, but I have a downside target of 559. So as you can see, as of this moment, the market is kind of just above the 5-day moving average, which is good. And once that breaks down, I do think we're going to come closer to the 557 or 559. So that's my downside target for next week. In addition to that, if you take a look at the 1-hour chart, folks, all right, so this is what we're preaching right now. This is a sharp rising wedge, and we are actually breaking down that rising wedge this afternoon so far. If we were to erase this whole entire move, we actually moved below the 50% retrace already since the lows after FOMC on Wednesday. You can see we gapped up really hard into the 572 area. All right, so that's going to be a major resistance, and we do expect that at some point next week we should be at least at a minimum retesting the 563 breakout. If you remember, 563, 564 was the previous all-time highs in August and September, and it couldn't break out. And once it did, it was actually ferocious, right? So we were able to catch a few points here and there, no big deal. But we're more interested on the downside now and a healthy correction off the 300 points that SPX has run since almost 1 week ago, more than 1 week ago. So we're looking at the 563 area. If this breaks down, we could possibly start buying dips in this area. So this is a video for all the viewers. If you're on X, if you're not part of the TRT community, that's cool. But you want to be a little bit, if you actually caught the top and got really good calls on Wednesday nights, you're probably in cash at this point, right? At least I hope you would be. And then wait for the dips to either the 563 or coming back down here in this area, anywhere like, let's say 563 down to 555, 558. These would be better areas to start looking at some stocks and equities or long calls versus buying up here where everybody was saying that we were going to go much higher. And as you can see, we're breaking down this rising wedge right now this afternoon. So I want to draw your attention to this chart as well. This is this percentage of stocks above the 200 daily moving average, and you can see this is the major resistance area. And we know that back on September 11th, this hit a low, and the bears just messed up right about here. And so are the bulls about to mess up really bad here? So this is the question for us for the next 2 weeks here as we evaluate, continue to evaluate this chart. But going over to the daily chart, I want to also give you guys a heads up. You have a daily divergence off the price, lower RSI, higher high in price. And there is also a daily stochastics about to roll over here. So we'll see. And also your weekly is making higher high in prices, and your stochastic and your RSI, is actually making lower highs. So those are what we consider bearish divergences, and you need to be careful if you are in longs. Now, with that being said, the reason why we're also bearish is because all of your Mag 7s gapped up on Wednesday morning. You have a gap at 222 for Apple. You have a gap here at 229 for Tesla. You have a gap at about 149 for AMD. I'm going to pull up AMD chart here. So typically indexes may not have to fill the gap immediately, but these tech names generally do come fill the gaps at some point. So 149 is a gap. NVIDIA has a 114 gap below the market, and you can see it's starting to come pretty close to come filling this gap here at 115 and 116 area. And in addition to that, it's not just those things, but you got an Amazon gap as well, all the way down to 114. I'm sorry, that's NVIDIA. Amazon, pull up Amazon. There you go. All right, Amazon's got a gap. Actually, I'm sorry, Amazon actually filled the gap today, and actually you can see it went pretty far in terms of ripping. So basically, what we're saying is maybe I think Monday, Tuesday, Wednesday, first part of next week, you should expect that these gaps to fill. But it also, once they filled, it becomes a much better opportunity to go long on these stocks versus chasing what everybody else is chasing on FinTwit or social media. But like I said, you want to wait for these areas to get tested, or at least 563 to get tested to go long. I have a good feeling that this entire move from the post FOMC at 560 to 572 will probably get you raced by Monday or Tuesday. So that's my speech, guys. Hope you